You don't need 100 doors in real estate to become financially free. What you need is a clear path that fits the stage in life that you're in right now. I'm gonna walk you through the 4 ways to invest in real estate that will actually set you free. Each one of these can be done individually or in combination, depending on where you're at and what goals you have. I'm Kassidy Warren, and I started investing in real estate by renting my spare bedroom out for $35 a night. Most people think they want passive income. Most people think that passive income is what's gonna set them free. What they don't understand is that financial freedom comes in stages. You need to create escape velocity to get out of your situation and then start to build real wealth. Real estate isn't just one strategy, but it's best to pick one strategy and go deep. Go all in on one thing for as long as you can, and then go and diversify depending on how your situation changes. My goal is to help you get wealthy. My goal is to help you quit your job. My goal is to help you become free. I quit my engineering job after 15 years in the corporate world because I'd had enough. I saw that there was nowhere else to grow, there was no more opportunity, I was getting burned out, and I was building something for somebody else when I had the deep down desire to build something for myself. And I know that you have that same desire. Here are the core 4 paths that I used and you can use to create financial freedom in your life. And please hit that like button, hit that subscribe button. I'm gonna be creating more real estate content to help you on your financial freedom journey. The first path in real estate investing, and where most people start, is with cash flow. Cash flow is what pays all of your expenses, pays all of your debt, and everything that's left over at the end of every month after paying everybody is your cash flow. Usually, there's not a lot left over at the end of the month. So you have to stack properties. You have to buy more assets to create enough cash flow so that you can replace your regular income. You are used to going into work and working 40 to 60 hours a week, punching the clock, trading your time for money. The great thing about cash flow is you no longer have to trade your time for money. You get cash flow every month based on providing housing, or if it's a short-term rental, providing a guest experience and hotel rooms or storage units, depending on what you're buying. So to create enough cash flow, you have to buy enough assets that will allow you to quit your job. In some of my other videos, I talk about keeping your job as long as possible because you can leverage that to go buy more properties, create more cash flow, and create more equity. Cash flow, in my opinion, is the lowest value part of real estate investing, but it's usually your first step because that allows you to quit your job, or that allows you to have more options, that allows you to take a break, take a sabbatical, take some time off. If you can convert an existing space in your house, like a spare bedroom or a basement or an attic or a garage, or maybe you have an ADU on the property, if you can convert that into a long-term rental or a short-term rental, that's immediate cash flow that you can start putting into your bank. At a minimum, it reduces your expenses, which frees up more money for yourself. Otherwise, if you're buying new property, the highest cash flow assets are usually short-term rentals, storage units, residential assisted living, or building an ADU on your property. In terms of wealth building, cash flow is the lowest and slowest way of doing it. So that brings us to path number 2, building equity, forcing appreciation. This is where the real wealth is built. This is usually the second phase. Now, you can combine cash flow and equity. That's where the money is made, is when you can create cash flow, force appreciation, and create a lot more equity in your properties. This is the way that I built wealth in real estate. Is I bought 2 short-term rentals a year, and with each property, I made improvements, I increased the value of the property, and those improvements also created more cash flow in the short-term rental. We designed them really well, we ran them really well, we bought in great neighborhoods, and that created high cash flow and high appreciation, which added to our ability to go buy more real estate. The reason that I like equity is because you generate a lot more wealth and higher numbers and higher returns through equity, through forcing appreciation. Because you're buying a property with debt, because you're getting a mortgage, you're able to only buy that property for a fraction of the price. This is your down payment, your closing costs. Maybe you have a VA loan and you don't have to put anything down. So that means anytime you increase the value of the property, that is all money in your pocket. Now it's tied up in the asset, it's equity, it's tied up in the asset, in the house or whatever property you have. But when you create equity, that increases your net worth. And it gives you more options. You can do a cash out refinance, which means you're actually pulling money out of the house and into your pocket. You can sell the property for a profit and then go turn that into another bigger property and do the same thing over and over again. Or you can just let it sit and continue to grow in value naturally over time with the market. The best ways to create equity in real estate, in my opinion, are through short-term rentals, where you do great renovations that increase the value of the property in the right neighborhoods and the right markets, or you buy commercial real estate like a hotel or multifamily or storage. You improve the property, you improve operations, you improve income, and that actually increases the actual value of the property. And with equity growth, the sooner that you can get into bigger deals, the sooner that you're gonna make a lot more money. The amount of time and effort it takes to do a renovation on a $300,000 house is relatively the same as it is on a $1 million house. But you're creating a lot more equity and value when you're working on higher value assets in better neighborhoods. So these are the two paths combined that really create a strong strategy for you to be able to go live the life that you want. That brings us to path number 3 for building wealth in real estate: investing for tax purposes, or tax optimization. So this is the stage at which you've got good cash flow, you've got good equity, maybe you have another job, or maybe you're selling some things. You're either selling properties, or you're selling a business, or you had a great year at work where you're making a lot of money. The only real way for a regular employee or someone that's self-employed or with a small business to reduce their tax liability is by buying real estate that they can depreciate. Depreciation is your ability to write off your entire property. All of the real estate that you buy can be written off as what's called a paper loss. What that means is that on your tax forms, when you buy the right real estate, it will look like you lost a bunch of money. And that can be used to eliminate or reduce your tax bill from your regular job, or if you have capital gains, or anything else that adds to your tax liability. When you see houses that are really expensive that people buy and then they just sit vacant, a lot of times that is for tax purposes, that they bought it to offset when they sold a business or they sold property or had a big capital gains event. They are using the tax code to offset their tax liability. It's not about what you make, it's about what you keep. And I interpret that as meaning, how do we reduce or eliminate our tax bill? This is the phase of investing, which you can start a lot earlier than you think. So if you're buying property and building equity, you want to be thinking about how your taxes are going to be affected. The only other way to access this is through cost segregation and depreciation with a short-term rental. There's the short-term rental loophole, and that allows the same thing. You don't have to be a real estate professional. It's easier to meet the requirements of the short-term rental loophole and offset all of your active incomes. So this phase of real estate investing with tax optimization, you can actually access in the very first step. Your very first property, you should be looking at how you can eliminate your tax bill so that you can continue to buy properties. Think about it. Let's say you have a $50,000 tax bill that you pay to the IRS every single year. It comes out of your check every single month, so you don't even think about it. But you're likely paying $50,000 or more to the IRS right now. Instead of paying that $50,000 to the IRS and it going away, you can take that $50,000 and go buy a piece of property that produces cash flow, creates equity, and now you don't even have to pay taxes. So instead of that money disappearing, that money now turned into a cash flowing, appreciating asset. And that is how you build wealth in real estate. There's also some downsides to taxes. If you decide you want to flip houses where you buy a house, you fix it up and you sell it, you are going to have a tax liability. You have a capital gains tax, and you actually have to pay income tax on whatever you made on that property. So if you buy a property for 400 grand, you put 100 grand into it and it's worth 600, you have to pay taxes on that difference. On that $100,000 difference, you have to pay taxes on that as income taxes. This is why I don't really recommend flipping, because it's a lot of time, a lot of effort, a lot of headache, and there's more taxes and not as much margin. You're more at risk of the market. So flipping is not tax advantageous. Buying and holding and creating value is more tax advantageous. Here's an example of how someone could eliminate their tax bill. So that person that is making $100,000 is only taking home $60,000. That means they have about $40,000 in taxes. Let's say they go use that $40,000 and some change to go buy a $400,000 house. That $400,000 house in the first year alone will give them an $80,000 write-off based on our current tax code. So they have a $40,000 tax bill usually, but they have a $80,000 write-off. that means that at the end of the year, they're gonna get a $40,000 refund because they overpaid by $40,000. And then they still have this $40,000 loss. That actually gets carried over to the next year. And they're able to continue to take losses year over year over year until their depreciation runs out. I'll make a video that goes deeper into depreciation and the tax benefits, but it's one of the biggest reasons why you should be investing in real estate and why your partner or your spouse should be a real estate professional, or you. Well, the fourth path is velocity of money. It's trading up. The real step up in net worth, the real step up in wealth is once you can take all of your existing assets and trade up into larger assets. Meaning you've got a bunch of equity sitting in your houses, your triplexes, your duplexes, your short-term rentals, your hotels, whatever you bought, you've got a bunch of equity. And so now you want to take that equity through either cash out refinance or selling or getting a line of credit, and you want to take that money and you want to go buy more assets to produce cash flow and increase your equity. You essentially go through that same cycle again, but instead of buying lower dollar, lower value assets, you are going to trade up. And when you trade up, now you're creating more cash flow and more appreciation, total dollars, because you're buying bigger assets. So instead of renovating a $300,000 house, you're going to go buy a $750,000 house and renovate that. And usually you'll be able to create more equity in total dollars by doing that. Your percentage return might be a little bit lower. Maybe it's better, I don't know. As soon as you take your equity that you gained and trade up into the next asset, that's when the real wealth starts to generate. That's when the snowball really picks up. And so usually at year 5 is when you want to consider selling or doing a refinance, depending on what your situation is. But at year 5, your appreciation might have flatlined. You're not putting any more work into it. You might need to make a decision about, do you replace things? Do you add more money? And so here are some guidelines that I like to think about of when to trade up, when to sell, or when to do a refinance. At or around year 5, most of your tax benefits start to go away. You've taken all the depreciation, so you're not getting any write-offs or losses like you were in the first 5 years. So your appreciation might be going up a little bit, but it's not that big jump that you made when you made the renovations. Your cash flow is probably around the same, maybe a little bit better from when you started due to inflation. And so you need to look at, are you going to do a refinance or are you going to sell? The way that you figure out if you're going to refinance or sell is by looking at how much cash flow you get and comparing that to the equity that you have. So if a house has $100,000 in equity and it nets $10,000 in cash every year, that means if you sold, you would have 10 years of cash flow all in one hit. And then you can take that $100,000 and go buy a bigger property. If you just did a cash out refi, you don't get access to all that equity. You only get access to a portion of that equity. You're not getting taxed on the refinance. You may have a tax situation if you sell, depending on if you do a 1031 exchange or not. But when you sell, you have more money so you can buy more assets. With a refinance, you get less money because they limit how much you can pull out. So you can only go buy a certain amount of property. Money likes to move. And this is the phase where when you start moving it, this is when the snowball really starts to pick up. You were building your portfolio, building your foundation, and now you're gonna trade up. Now you're gonna take all that equity and you're gonna go buy more real estate, and you're either gonna double down on the strategy that got you there, just do it bigger, or you're gonna go find a strategy that is more in alignment with your goals. If you have a ton of cash and you don't need cash flow, go build equity. If you want cash flowing assets, go buy stuff that's gonna cash flow. If you need tax breaks, then go invest for tax reasons. But by trading up and buying bigger or buying more assets, you're starting the tax cycle over again, you're creating cash flow, and you're creating more equity. Like all things, there's risks to doing all of this, but this is the way. The sooner that you can trade up, the sooner that you're gonna make more money and build more wealth in real estate. I started at $35 a night, renting my spare bedroom out. And then I bought 2 properties a year, fixing them up over and over again using this strategy, creating cash flow, creating equity, and then now we're in the process of selling and trading up. I was able to quit my job and live the life that I want to live. So in closing, I want you to pick one of these strategies and start working on buying your first deal as soon as possible. I'm interested in your path and your journey, so please reach out to me on Instagram. I'm at Kassidy.Warren. I want to see what you're doing, what you're buying. how much money you're making and the life that you're living. This is my greatest desire, is to create freedom for you and everyone in your life so that you can go live the life that you want. As always, I appreciate you, and please hit that like and subscribe button. I'll see you next time.